Good evening, everyone. Can you hear me?
Yes, sir. I can hear you clearly, sir.
Okay, good. Good evening, everyone. So today we are continuing with our refresher course online. We are moving on to another topic today, the audit approach. The audit approach. This is chapter 6 of your ICANN study pack. Now, what's audit approach? Now, audit approach is directed to the gathering of relevant and reliable audit evidence to support the expression of an opinion on the account. In carrying out an audit assignment, the auditor should. So what this one is talking about is that when you are going to embark, before you embark on an audit engagement, there is need for the auditor to have an approach, how he's going to go about it. What are the things he needs to do? And one of the things he needs to do is that he needs to, first of all, know the client. By knowing the client means that he needs to know what are the clients, what are they up to, what is their business, what are the major risks that the business is faced. The other thing he needs to understand is that he needs to also know the approach is going to use, because there are some clients that are well established and we have some clients that are not as that established. So what I mean by not established is that their processes are not streamlined, so they use manual. So if we are auditing a client that is not in an organized environment or does not have a standardized process or system, then there's an approach you use. So for the auditor to be able to carry out a successful audit, he needs to he needs to know the approach that will suit each client. Like I always say, there is no two clients that are the same. They might have similar operations, but they are not exactly the same. One thing will make the other client to be different. And that is why the audit approach is very, very necessary. Now, audit approach is also part of the audit planning, because when you are planning your audit, when you have finished the plan, you need to talk of what are the strategy you are going to adopt so as you have a successful engagement. Now, for the ICANN examination, the ICANN has recognized 4 major approaches, and they are business risk approach or risk-based approach, system-based approach, a substantive testing approach, and the statement of financial position approach. Now, let me start with the smaller ones first. Let me start from the bottom. Statement of financial position approach. Now, this is an approach that is used when you are auditing or when your client is a small entity. Small entity means that business that are just starting up or business that have not established, they're not well established. So you make use of the statement of financial position approach. By statement of financial position approach, we mean that every business is expected to prepare their statement of affairs, more like the balance sheet, the old balance sheet. Now, the balance sheet contains information that has to do with the business has performed in the past 1 year. So the audit approach in this regard means that what the auditor will do is that it will look at the balance sheet, that is the statement of financial position. It will look at it, looking at it from both sides, that is the current period and the prior year. That is, let's say you are auditing for 2019 now or 2020, you will look at 2019 and 2020 side by side. So when you put the two balance sheets together or the two statement of financial position together, you will be able to determine how the business has performed. Now, what is the method we are going to use in this regard? We are going to use a method under the analytical review procedure known as what? Net changes. Net changes. What do I mean by net changes? You bring the two statement of financial position together. You will now compare like for like, meaning that, oh, for non-current assets, 2019 you had 200 million. For 2020 you had 180 million. So there's a decrease of what? 20 million. So that 20 million account for a decrease. So you need to investigate why there was a decrease. It could be that maybe they sold some of the assets, maybe they transfer some of the assets, something happened to the assets, you need to investigate. Or you look at your current asset, you look at it, maybe you look at total current asset, maybe there was an increase. For 2019, there was an increase, and 2020, there was an increase of, let's say, 50 million. So you need to investigate why there was an increase. Because it is probably that some of this information you have there, if you don't investigate as an auditor, you might not have done a thorough job. Because as an auditor, you need to have a skill known as, you need to have a skill, more like a skill. You have to have an inner eye to be able to have a probing mind, the one that we always call professional skepticism. You need to have a probing mind to ask questions. Because if you don't ask questions, your clients will assume that maybe you know. And assumption is the lowest level of knowledge. So when you are doing an audit, you need to ask questions. When you ask them for the draft statement of financial position, they send it to you. You look at it, ask questions. For instance, you look at inventory, you see that there is an anomaly there or you need clarification, ask questions so that they can give you the insight as to what has happened in the business. If you need to call for a source document, ask for the source document so that you affirm yourself of those doubts, so that you know that, oh, you have cleared your doubts. Because if you don't clear your doubt, at the end of the day, if there's an issue with that audit, you will assume that it will amount to professional negligence. So that is what you do. So you make use of the analytical review procedure, that method known as net changes, net change review. So you look at two comparative figures for 2019 and 2020. So whatever will be the difference will now be is what you now investigate. And what you also need to understand is that when you use the same financial position, it's more like using, because at the end of the day, whatever you get from the same financial position could be used to determine the statement of profit and other comprehensible income. Because some of the information you have in the same financial position are also represented in the statement of profit and other comprehensible income. So, and there is an equation that says that capital plus net profit is equal to asset. That is, when you look at your same financial position, you have two sides, asset side, liability side. By the time you add your capital and your net profit and your liability, add everything together, it should sum up to what you have at the credit side, which is your asset side. So with that, you'll be able to know if the company has performed very well. Like I said, where instances where you make use of same financial position approach are one, company that a startup business, a small business, or a business where they don't have organized system, there are no processes in place. Where you have those instances, then you can go ahead and use a statement of financial position approach. The next one we want to talk about is the substantive testing approach. Now, so substantive testing approach, please don't be confused. Now, why am I saying so? If you use substantive testing, what it means is that you'll be doing more of what? Verification and vouching. That is verification of assets and vouching of expenses and other transactions. Vouching of other transactions and expenses and verification of assets. So under the statement or under the substantive testing approach, two methods are used. Remember, when we talk about how you test for the efficiency of the internal control system of any organization, we carry out two tests. The two tests before now is usually called compliance testing and substantive testing. Now, this name has changed because, like I always say, audit is an evolving subject. It involves every day. The new name for those two testing now are compliance testing is now known as what? Test of controls. The new name for compliance testing is now test of controls. All what you know or you regarded as compliance testing is still what is being done under test of controls, to test that there is an existing internal control system and to show that all those they laid out to do in their standard operating procedures are what they are doing. So you will check all those things and check, oh, do you have this policy in place? Yes, you have it in place. You are not doing an in-depth audit then. You are just asking questions. So by the time you are done with that test of control, you'll have had a 50% assurance that, no, the audit that I'm doing, the engagement I'm doing is on the right side. I'm on the right path. You'll have that 50% assurance. You are not yet good to go, but you have some respite, a relief, an assurance that, yes, you're on the right side. Now, for you to go on with to have 100% assurance that the audit you are doing you are doing the right thing, you need to carry out what is known before, you call it substantive testing. But the new name now, because like I told us, it has evolved. The new name now is now test of detailed transactions. Test of detailed transaction. That is the new name for substantive testing. Test of detailed transaction is the new name for substantive testing. All what you do under substantive testing is what you do. You verify assets, you vouch transactions. Those are the things you do. So all those things they have told you that they have, that is the time you now have to carry, you now ask for documentation. Let me see how you have done it. It is under the substantive under the test of detailed transaction that you do what is known as a walkthrough test. Walkthrough test is that you take a transaction, a particular transaction. Maybe you want to investigate payment. You look at how they initiate the payment. You look at the payment system. You look at what are the processes it takes before the money goes out. Those are the things you look out for. So by doing that, at the end of the day, you will have been able to check if there are controls in place, one. Two, if the controls that are in place are adequate. So where the controls are not in place or the controls that they have are inadequate, you will need to profile recommendation on how you can strengthen the internal control system around the payment process. So that is what you do. So why am I bringing that in? Because you might relate the substantive testing you have here to that. But what I want us to understand is that when you're looking at substantive testing approach, you are making use of two types of methods here. You are using two methods in this one. What I mean by that, what I'm saying here in essence is that you make use of test of detailed transaction, more like the substantive testing itself, and you're going to make use of analytical review procedures. You make use of test of detailed transaction, and you are going to also use analytical review procedures. I've explained what I meant by test of detailed transaction. Now, analytical review procedures. Now, analytical review procedures is a procedure that shows possible relationship. It shows possible relationship between financial and non-financial data. It shows possible relationship between financial and non-financial data. So what it means is that you try to possible in that sense is the spelling is PLAUSIBLE, possible. If the other name you can use, you don't want to use, you use a related transaction. When items are related, then you can also use that method. Now, what you also need to understand is that when you are using analytical review procedures, there are three methods contained in that analytical review procedure. There are three. You can either use trend analysis, or you use ratios, or you use net changes. Now, under trend analysis, what it means is that you are looking at a series of years. Let's say you are taking like 3-4 years. You look at the performance of the last 4 years. By looking at the performance of the last 4 years, you'll be able to determine what this year's performance will be. For instance, if you look at your revenue from 2016, 2017, 2018, 2019, you might not be able to predict accurately what your 2020 revenue will be, but you have an idea, a rough idea of how it's going to be. It might not be exact, but you have something that is very close to what it's supposed to be. So that is when you make use of trend analysis. Then your ratios is when you make use of your other all the ratios you can ever think of. Asset test ratio, current ratio, labor turnover ratio, capital employee ratio, all those ratios, raw material ratio, all those ratios, bring them together. Those are the things you deploy when you are using substantive testing approach. So substantive testing approach can also be, why are you using that? Because what you need to understand is that when you are using substantive testing approach, another reason you are using it is because, one, when there is no standard process in place, when there are no organized accounting system, information system, management information system in place, you will need to do a physical verification and vouching. So you need to ask for source documents and check if they have done. But one limitation of this method is that you can only make use of what you have presented. For instance, if the management has decided to eat certain information from you, then that means you cannot do otherwise. You cannot know. It's what they present to you that you will use. So that is why this one is somehow limited. It's similar to when you use the same risk affects the statement of financial position approach. Both are the same because you make use of what information that was provided to you. So you don't have a system to compare if they have given you everything. So that's what you do in that regard. Then for the system-based approach. Now, system-based approach is an approach that makes use of the test of controls that are in existence while the financial statements are being prepared. I say it again in another way. When you use system-based approach, you are evaluating what are the control systems that have been put in place while they were generating the financial statement that was presented to you. So what that one means is that the internal control system needs to be what? Very, very efficient and effective. So that one will take us for us to talk more on internal control system. Now, internal control system has been defined as a whole system of control, financial or otherwise, established by management to secure the assets of the company and ensure there is an efficient running of the business, or business is run in an efficient manner so as to attain the set objective of the business. That is internal control systems. Now, for a good internal control system, you have to know there are 5 components that makes up a good internal control system. And they are, the first one, the control environment. Control environment. The control environment is the sole responsibility of the management. Management is responsible for putting in place the vision, the mission, the goals, the objective of the business. So it is from that control environment that you'll be able to know the direction the company is going. What is the company set out to do? That's when you know. And 3 things are contained in that control environment. They are governance, compliance, and regulation or regulatory. Any of you can use any of them. So the governance here means they have to put in place procedures, processes, system that will work for the company, system that will work for the company to enable the company to achieve the set objectives. That is what you do under governance. Under compliance, you have to ensure that all the laws that are in existence in the country, because the company is not existing in isolation of the country. So all the laws that are related to the company that is being formed must be what? Must be complied with. So you have to see and ensure that there is compliance with the laws. So there is no issue with that. So you have to ensure that you comply with the laws. So one thing you also need to understand is that the last one, which is regulatory, is that you must ensure you fulfill all righteousness to register the company with all the relevant laws and regulations. So you need to have everything, you need to observe everything that has to do with the laws and regulations of the land. So there are three things now. You start with governance, you start with compliance, then you have the regulatory. So you have that, those three aspects are the responsibility of the management. They are the ones started with that responsibility. The second one we look at is the entities risk assessment. Every business must ensure that it puts in place risk management framework that checks the company to be able to attain a set objective despite all odds. What I'm saying is that every business has its own risk. Every business has its own challenge. Now, it is the responsibility of the management to be able to mitigate those risks. At the same time, they should be able to achieve their set objective, not minding the risk. So what they are saying here is that the management should be in a position to design an effective risk management framework that will track all those risks that affect the business. Risk in business at most times cannot be eradicated, but you can mitigate it. There are some risks that you need to avoid. You don't need to even bother yourself. You don't need to think about them. There are some that you need to take on board, you need to accept. And there are some that you need to what? To transfer. When you transfer risk, that means you are taking it to the insurance company. Like for instance now, your assets, you need to insure your assets. There are times you will need to insure your staff against your company against fraud. If your clients, if your staff, you know that you can't trust them, you might need to take a fidelity guarantee insurance, and that will take care of fraudulent staff, so that even there is a theft or fraud in the organization, that insurance will cater for that aspect. So the risk aspect is very, very important. And what is risk? Risk is anything that stops us from achieving our objective. So anything risk, you have to look at, first of all, the impact. Secondly, you look at the likelihood. Impact and the likelihood. So there are some risks that they don't happen all the time. So that is the likelihood. What's the likelihood that there's going to be an earthquake in Lagos State? The chances are what? Very, very slim. What's the chances that there's going to be a natural disaster, another natural disaster? Is very, very slim. But for instance, like, what is the chances that there's going to be rainfall? That one, you know that likelihood is very, very high. So that is what likelihood is. Then the impact is that how it's going to affect the business from achieving their set objective. That's another thing you need to consider. How it's going to affect the business in achieving their set objectives. So that is what you look at when you are looking at the risk, the entities risk assessment. Then the third one you are looking at is the control, is the accounting and information system. Now, every business must have a way in which they capture and record their accounting information, as well as their management information. Now, accounting information here means that there are times you might not be able to afford the accounting software or the accounting ERP. So if you cannot afford it, then you should have a manual way, whether you use Excel to capture all your expenses, your transactions generally, basically. So you look at those things. Then under the information system, you are looking at, for instance, you should be able to manage your materials. For a manufacturing company now, you should be able to know when you have enough materials that will make your staff to do overtime. When you don't have enough materials, you're able to plan your staff in such a way that, they should just work regular hours, working hours. There's no need for overtime. Because if you don't have those plans, your staff will be doing overtime without achieving anything. The productivity will be very low, and yet you'll be paying so much money. So those two things, you need to be able to balance it. The accounting system, ensuring that all information that relates to your business, you plan for it, and ensuring that all transactions that you embark upon as a business person are what? Are captured and are recorded on time. Timeliness is very, very key For instance, you are in business that maybe you just make little sales in a day. Don't say that, oh, I'll wait tomorrow before I record it. Record it right now and then. Because tomorrow, you don't know what will happen tomorrow. Maybe there will be some other things that will distract you, then you forget. And when you forget, that means you have underrated or you have undervalued your revenue. So that is why you need to have somebody or a system in place that captures and tracks all your expenses and your revenue. The next one is your control environment. Control activities. Now, control activities are those activities that you do in a way so as to ensure that you put your company on the right track of achieving their set objectives. So there are some activities that you need to do. For instance, you need to ensure that there is a segregation of duty, because if one person is the one doing everything, one day that person is going to break down. Another thing that will happen is that if that one person is doing it, then productivity will be hampered, because you will be able to do so little at a very long time, over time. So that's what it means. So you need to look at those activities you need to check it and ensure that you are meeting your set objectives. Then the last component is monitoring of controls. So that is another aspect, and this is an aspect where the management will set up a unit, internal control department, internal audit department, compliance department, anyway, or some will even make the three together. So that department's responsibility is to check if the company is meeting up with their set objectives. So where there are gaps in the implementation, they will identify and escalate to management. They will address it, and the company will be moving forward to achieving their set objectives. So those are the 5 major components of a good internal control system. I take it all over again. I list them again. 1, control environment. 2, entities risk assessment. 3, accounting and information system. 4, control activities. 5, monitoring of controls. Once those 5 components are in existence, then your internal control system is as good as what? Efficient. Now, other thing you also need to understand, under the internal control system, we look at the types of internal controls. There are 10 of them. There's an acronym I know you know, but let me just recap it. It's called Papa Musab. Papa Musab. So I just give us the meaning. First one is what? Personnel. Ensure that you have the right personnel control. Ensure that you have the right personnel at the right time, at the right place. That is personnel control. Then you have authorization and approval, which is the first A. So ensuring that every transaction is duly authorized and approved. The next P is physical controls. Physical control, ensuring that you put in place physical controls such as padlock, doors, biometric locks, all those things in your company premises to secure your assets. So essentially, the physical control is for your assets. Then the next one is I've talked about personnel. Then the next one is accounting and arithmetic controls. So you should ensure that all transactions are properly recorded and presented on time. So you don't need to wait for anything. Once you carry out the transaction, ensure it's properly recorded and is presented in the books. Then the next one is management controls. Management control are those controls that management puts in place to track that the business is moving in the right way. For instance, when you carry out what is known as material variance report, sales report, budget variance report, all those are examples of management controls. So as to ensure that you are on the right track. Then the O is organizational control. Every business must have an organizational chart to show who reports to who, line of responsibility. Then the first S is called segregation of duty. Segregation of duty control means that no one person should be allowed to carry out a transaction from initiation to completion. There should be checks and balances along the way. Then the next one is supervisory control. Supervisory control means that at every point in time, there should be somebody supervising what another person is doing. so that there is check and balances, so that they are to reduce errors and to reduce issues, so that we're able to manage issues. So when the manager calls for a document now, there's somebody else that will review before it gets to the manager, so that the manager will spend less time in reviewing the documents. Then the next one is acknowledgement of performance. Acknowledgement of performance. What that one means is that at every point in time, once you review a document, you should ensure that you append your signature. That's why if you are very observant, you see that when they review a contractual agreement, they sign on every page of the document that they have reviewed. What this one is saying is that if you had not read the document or the agreement or anything, please don't sign. But once you have read and you have understood what is in that document, you can go ahead and sign. Then the last one is budgeting and budgetary control. What that one means is that for every transaction, there must be an existing budget. If you have not budgeted for that thing, you don't spend money on it, unless you now do what is known as a supplementary budget, or you do what is known as environment. That means you move money from one account code to the other before you be able to spend. So those are the 10 types of internal controls that you have. The next thing we also need to talk about under the system-based approach are the limitations of internal control system. Internal control, as good as it has its own limitation. The first one, management override. Management at times tend to override the control that they are putting in place, especially when they want something fast. You tell you that, please step that control aside, let my transaction go. After you treated my transaction, you can bring back the controls. That is one of the limitations. Secondly is human error. What that one means is that everybody is subject to mistake. Nobody is perfect. So there is bound to be error at any one point in time. So you should ensure that you should be able to manage your error, and so that it is inevitable. That's another limitation. The third one is collusion. Collusion here means when two or more people have decided that this control will be breached, there's nothing you can do about it. The NEDC probe that is ongoing now, you can see, if you are very observant, you see that most of the things that happen there is as a result of collusion. The staff, they colluded together, and that is why they've been able to move out money, and now they are talking about auditing the entire process. They are going to start the audit from year 2000 to 2019. That is 19-year audit. Forensic audit is what they are doing. So collusion has contributed a lot to what has brought about where NDDC is today. Another limitation you want to look at is conflict of interest. Conflict of interest happens when you are doing two things at the same time, and one of them, those two things are related. So when you want to serve two masters at the same time, there is bound to be issues. So the same thing will happen to that, and that also played out in the NEDC saga that is currently on. Most of the staff there, they have their own business. For instance, they know that there is a contract that will be awarded. As the MD of that NEDC, you say, that money that's being paid to that contractor, let me float a company and use a proxy. When you have a proxy, you float a company, you now see that they submit their bid or tender. When they submit, you now give it to your company, knowing fully well that that company is your company, and that money will be given to that company. So those are some of the limitations of internal control system. So what we are saying here is that under the system-based approach, you ensure that you have a good internal control system. And when there's a good internal control system, all those types of control that we talked about, they must be in existence. Where they are not in existence, then that means it won't be effective. To ensure that all those things are in place. Then the last one is business risk approach or risk-based approach. What that one means is that you are looking at two things in this regard. You are looking at the business itself. You're looking at the risk that the business is facing. So for instance, now you have a company, you have a business that is a bank. Now you know that the bank has its own major risk. The risk that bank faces is that it's prone to theft, because your staff sees money every day. If you don't put control around your cash, At the end of the day, you not have a profitable banking operation. So you have to put system in place. So that is for the risk approach. Then the business risk approach, we are looking at it from that angle of the sense that what are those things that might affect the business from achieving its set objectives. What are those things that may affect the business from achieving its set objective? So the things you are looking at two factors, internal factors and external factors for business risk. Internal factors are, for instance, you have your staff are not competent enough. When you don't have a competent staff, then it's going to affect whatever you are doing. You'll not be able to achieve your set objective. That is one. Then another thing that could happen is that when you are not coordinated as a business person, you are not focused on know what you want to achieve at any point in time. It can also affect you from achieving your set objective. The external factor could be an instance when there is a competitor. For instance, when Coca-Cola had a competitor, Biggie Cola, you saw what happened to them. Same thing happened between Cowbell and Picnic. So all these things are some of the things you look at. Then another thing you look at under the external factor will also be as a result of laws and regulation, impact of laws and regulation. The new CAMA 2020 that has just been approved now, promulgated into law. So there are so many issues that people are clamoring for. There's an outcry on that. So it has its own effect on the business. The Finance Act that was approved some time ago also has its own effect on the business. So these are some of the issues that you look at. But for the one thing I want us to understand here is that for the business risk approach, it's not every client that can adopt that approach, because you want to adopt a business risk approach. First of all, you need to have a good system in place. Good internal control system you must have it. Secondly, you must have a structured environment. Then thirdly, it's only the big four that can successfully implement this business risk or risk-based approach, because it's highly technical. It's very, very technical, because you should be, as an auditor or as an audit firm, you should be able to give your clients, when you are using business risk approach, you're able to forecast on how the business, what will be the outcome for the business in the next 12 months to come. You should be able to give them that update. So it's very, very, very important. Then, for another thing you need to understand is that the four approaches that we have is not compulsory you use one. There are times you might have a mix. You might have a mix between business risk approach and system-based approach, or have a mix between system-based approach and substantive testing approach. It depends. You can have a mix. It's not cast in stone that you must use one approach at every point in time. You might have a mix of the two. So that is that I want to share with us on audit approach. So I want us to look at a question two of the of this chapter. That is the one they call question 5. I want us to quickly read it, and we'll have a discussion at the end of the period. I'll give us like 5 minutes to read. 5 minutes to read. I'll come back and continue. Okay. So let's go over the question together. The Angem Art Gallery and Museum (HAGM) is in the center of a city that is popular with tourists. About 65% about 65% of its revenue comes from admission fees and annual membership, and about 30% of its revenue comes from sponsorship of special exhibitions by companies. Most of the remaining revenue comes from a small cafe and gift shop in the art gallery and museum. Admission fees come from sale of tickets to daily visitors and from annual membership subscription from friends of HAGM who are entitled to free entry to the art gallery and museum at any time. Day tickets can be purchased by credit card in advance by a phone hotline or at HAGM website on the internet. Alternatively, day ticket can be bought with cash or credit card at the door on the day of the visit. Reduced prices are available for children, students, and individuals aged over 65. And there are also special reduced price family tickets for 2 adults and 2 children. Sponsorship arrangements are agreed up to 18 months in advance. Some corporate sponsors, particularly transport companies, that is, bus companies and railway companies, sell advertising to HAGM. The management of HAGM have identified the following applicable risks that need careful attention. They believe that these risks should be managed actively. There is a failure to attract more visitors because of the poor condition of many of the paintings in the art gallery and of the items in the museum. Paintings must be restored regularly because their condition deteriorates. HAGM has just one specialist restorer who is unable to keep up with the required volume of work. The management of HAGM recognized that investment in new items and the restoration of existing items is inadequate, but blame the lack of revenue for the problem. Some corporate sponsorship agreements may not be invoiced due to poor communication between the sponsor, HAGM sponsor managers, and the account department of HAGM. Some sponsorship arrangements are not invoiced at their current amount. This happens often when the sponsor is also a company that provides advertising for HAGM. Normal practice is for this sponsor to reduce the advertising charges from the amount they pay to HAGM in sponsorship. However, the account departments in HAGM are not.
Sorry, sir.
Hello? Are not giving the details of this set of arrangements. Some of the cash received from day visitors at the door may be stolen or lost or used by management for business expenses and does not reach HAGM's cashier. 5. The online booking system for buying tickets in advance on the HAGM website is not always available because the website is down. Required. Describe appropriate internal control to manage each of the applicable risks described above. B. Explain the financial statement risks that arise from each of these applicable risks. Now, if you are faced with this kind of a question in examination, let me give you a quick pep talk on that. When you are answering an exam question, you have to bear in mind that, first of all, once you are giving your question paper, please don't be too familiar with ICAD examinations. So Why I'm saying this is that ensure you read the instructions. Instructions you have in the last examination, the one they had in November, might be different from the one they had the one that is coming up in September. So don't assume that it's the same instruction that you had. So let me just go to the question. Because understanding the instruction of the examination is 50% true, or 50% success of that examination. But if you don't understand the question, if you don't understand the instruction of the examiner, and you go ahead and answer the question, you might have done the wrong thing. And some people will finish ICANN and they'll say that I've scattered ICANN, I've given them marking scheme. If you have not done the needful, definitely you will not have given ICANN the marking scheme, or ICANN will not have given you a pass mark that you desire or deserve. So when you have a question like this, first of all, we have your question in examination. Maybe you're expected to answer 5 questions or 4 questions. Always, you know that question 1 will always be compulsory. We all know that. Now, if you know that question 1 is compulsory, please ensure you don't start with question 1. Why am I saying so? By the time you start with question 1, you will have seen that you have wasted so much time on question 1. And there's one thing that is called exam phobia. Once the invigilator starts saying 10 minutes more, 2 hours more, 30 minutes more, at times it affects your psyche. So there are maybe your train of thought, you're trying to write something, they tell you 5 minutes more. I tell you, at that moment, some people are disorganized. So the best thing to do when you are faced with an exam situation, please, question 1, let it be your last question that you answer. And ensure you plan your time well such that you have enough time. Let's say it's a 3-hour question, you answer 4 questions. Maybe you use like 1.5 hours to answer all the ones that you know. Then you concentrate your last 1.5 hours on that question 1, because that question 1 always carries the highest mark. And one thing you also need to bear in mind is that when they say attempt all questions, please, question 1, when they tell you to attempt question 1, don't leave it unanswered or untouched. The little you know about it, please write something, scribble something down. Because even though you have answered other sections of the examination correctly, section B, section C, whatever section, you have answered it correctly, and you have not attended that question 1, I'm telling you, the students would be penalized. The students will be penalized. And I don't want that for our students. So we will ensure that you look at it holistically. Ensure you allocate your time correctly, and ensure that you have maximum time for that question. Even when they tell you that 5 minutes more, you know that you're only answering question 1. Whatever time they stop you, you know that at least you get some mark in that question that you have answered. Now, another thing I also want to tell us is that when you have a question like this, any case study, this is applicable to every subject, every part you are writing. Don't go to the requirement first. Please, I repeat, don't go to the requirement first. Ensure you understand the case study or the story first before you go to the requirement. If you go to the requirement first, it tends to cloud your sense of judgment. There are some things that you will not be able to see. You will be looking out for the solution to the answer or the answer to the question. So it is not advisable. So read the passage like two times, digest it before you go to the requirement. So by the time you are going to the requirement, be able to highlight those areas that are related to the answer. So that is that. So with this question now, you have read it, and it's talking about internal control, which is what we have discussed. System-based approach is what we have discussed. So what they told us is that we should look for describe appropriate internal control to manage each of these applicable rates described above. So the way they've answered is that this is the suggested answer to this question. Now, one of the major problems, if you look at the first risk that was identified, there is a failure to attract more visitors because of the poor condition of many of the paintings. If you read all through, there's one place they said they know that they need more people to do that work, but they say they put the blame on lack of revenue. So that's why they cannot employ more than one person to be doing the restoration of the artworks. So how can you how can you increase your revenue is what should be the topmost priority. So that the controls you are putting in place for revenue. So one of the things you need to do, you need to ensure that you pay close monitoring on revenue from different sources and from different types of day visitors. Remember, when we read the passage, there are different revenues lines, that different ways where money comes through HAGM. There's one for day visitor, there's one from sponsorship, there's one from friends and family, friends of HAGM. All these membership are forms of revenue. So what are the things you need to do? You need to ensure that there's a close monitoring. And we also said that if you look at that day visitor, they said that, let me show us what I'm saying. Day visitors, I want to show us something there. There's a place I'm looking for. The one that says that they are not, the place is not always, man, look at it. The number 4, cash received from day visitors at the door may be stolen or lost, used by management for business expenses that do not reach HAGM's cashier. So what they are saying here is that one of the things that you see there is that there is no proper internal control system to safeguard that day visitors at the gate. Just like when you go to the Palms in Lekki, you want to watch a film there. At the entrance, you have some cash points where you pay, whether you use cash or use your credit card or debit card. After you've paid, they give you a ticket. That ticket that they give you when you want to go to the cinema to watch any movie, there's somebody at the entrance to validate that the receipt or the ticket that you have is the authentic one. But somebody might use an old ticket. I want to swindle or prove smart. So you need to check all those things. So those are the things that they are looking at. So ensure that you check those tickets so that you know that the person that is going inside is going in with a valid ticket. And for those that are on membership, you should always tell them to come, give them a form of identification, maybe an ID card that shows the validity period for their membership. Validity period for their membership. For instance, if the tenure is for 6 months or 1 year, let it be on that membership card. If they don't come to that place with the membership card, they do not allow them to go in. And if they don't have it, so long they have their membership number, you can check on your system and validate that that person membership is still valid. So that is the way you can do that. Then the sponsorship revenue too. We said that there are some arrangements that is being made that they need to pay, at point they need to pay, give them some discount on what they are paid because they pay for sponsorship and advertisement. So that one too need to be streamlined. There should be a good communication between the sponsorship management and the accounts department of HAGM. That is one thing we need to also do. The other thing they also need to put in place, they have to have a budgeting system. Remember when you look at the Papa Musa, the last B, budgeting and budgeting control is budgeting system. If you don't budget, if you don't plan, you will not know how far you have gone or how much you have made, or how much you have achieved in a year. So you need to put that one in place. So how we use to track how much you have made. Then that one is for the first risk. The second one is looking at internal control may be applied to improve the detection risk and prevention risk of unrecorded sponsorship revenue. So what that one is saying here is that if you look at that number 2, they said some corporate sponsorship agreements may not be invoiced due to poor communication between the sponsor, HAGM sponsor manager, and the account department. So they must ensure that there is a good internal control system that tracks all these agreements. Somebody should be in the account department, and that person should liaise with the agent's sponsorship arrangement or agreement. They work with them to ensure that all the information that is needed are captured so as to prevent further loss of revenue. That's one thing they also need to put in place. Then, thirdly, they should ensure they separate money that is coming from the sponsorship, money that is coming from the sponsorship and advertising. They are differentiated. Look at it. They say some sponsorship agreements are not invoiced at their current amount. This happens often when the sponsor is also a company that provides advertising for HAGM. There should be clear demarcation, allocation of resources here. Which money comes from sponsorship arrangements, which money comes from advertising. They should be able to differentiate so as to know where the money is coming from. And where they know that there is a loophole or the money is not coming from there. For instance, if you know money is not coming from advertising, you might need to step up your game on improving your advertising skill to bringing in more people to advertise for the company. Then the fourth one, a variety of internal control is needed to reduce the risk of cash being lost or stolen. So one of the things, that one is for number 4. They say some of the cash received from day visitors at the door may be stolen or lost. Look at all what they need to do. So what they said here is that there should be somebody manning the cash point so that people do not just walk into the cinema hall or the place. Somebody should monitor that place, and all the money that they collect, they should be recorded. That's why you go to banks, when they collect money from you, from the bulk tellers or the front tellers, all of them, they have a record that they keep. At the end of the day, they will reconcile the amount that they collected from the bank and how much they disburse to the bank customers. So when there are discrepancies, they will call themselves together. That's why at times they don't let the manager to know. So among themselves, they borrow themselves money. Please help me to close this thing. I'll give you the money later. They do all sorts. Because once the manager gets to know, it's as good as saying that you are not professional enough. You are not competent to man that place. So they tend to do all those. So when you have all those things in place, you will be able to track how much goes in and how much goes out. Then the fifth one there, they said the online booking system for buying tickets in advance on the HAGM website is not always available because the website is down. So what they are saying here is that you should always have a backup internet service provider. For instance, if you know that, what's it called? MTN, maybe it's one of your main internet service provider, is bad or is not efficient. Have a plan in place. Whether you go for Airtel or you go for Swift or you go for SpectraNet, you must have a backup. Imagine you want to buy something on Amazon. How many times have you gone to Amazon and the website is down? How many times? It's always up. Or you go to Yahoo, you want to do something on Yahoo, your mail, you are not able to access it. It's because they have backup, they have chains of backup, they have 1, 2, 3 layers of backup. So that if one is down, the other one picks up instantaneously. So you won't even notice it at all. And that is how to do business, because most times, even with this COVID-19 that we are talking about now, people don't want to do face-to-face transactions. They prefer to do online. And that is why this man, Jeff Bezos of Amazon, is now the richest man in the world, clocking $200 billion now. He's the richest man in the world because most of his businesses are online. And that is the way to go now. Look at Zoom also, the Zoom we are using now. What was the value in 2019? It's not as it is today now. Because most people are they are trying to promote social distancing. So Zoom is taking over so many things. That is why you see that even Facebook now is trying to develop, they have even developed an app that will also replicate what Zoom does. It's a way, because they also want to cash in. Microsoft have their own. Their own is Windows thing. So everybody wants to cash in on this. So everybody is looking for a way out. So online business is a way to go. Any business that is not online now, such business cannot stand the test of time. So those are the things you need to do. Then the second part of the question, it says, explain the financial statement risks that arise in each of these applicable risks. Now, what you need to understand in this is that, sorry, I didn't explain that because that is more of the chapter 7 planning. Now, financial statement risk. There are 3 risks that affect the business. First one is the business risk, which is the one that I've talked about. The second one is financial statement risk. Then the third one is the audit risk. 3 risks. Now, the financial statement risk will come up as a result of the some of the issues that the business is faced. For instance, if a business has set out that they want to generate 1 billion naira in this year, then they have to put in place measures to ensure that they don't underperform. They might surpass it, but they should not underperform. So they have to put measures in place. So some of the measures they put in place to ensure that they reduce their expenses drastically, and they ensure that they have value for money. For every cover that they spend, they should be able to have value for it. So those are the things they need to put in. And by doing that, it shows that, and what is financial statement is saying that the financial statement might not show the true and fair view that it ought to show. Might not show the true and fair view that it ought to show because of that risk element. So what it means is that maybe because of what the management is doing, they put in some measures to see that, they don't want the financial statement to be too different from what they have projected. So they will do all that they need to do to ensure that those things are put in place. Then this financial statement risk will rub on the audit risk. That is the inability of the auditor to express a true and fair opinion on the financial statement that he has audited. So it's going to rub on the auditor himself. So the first risk is the business risk. Business risk will affect the financial statement risk. Financial statement risk will now ultimately affect the audit risk. So audit risk is the main one now. So when you have audit risk, we all know that one is very, we'll still talk about that in chapter 7, which is audit planning. So what we are saying here is that question now talks about, let's look at it again. Explain financial statements that arise from each of these applicable risks. So let's go to the suggested solution. So the first one, they say the numbers used in this part of the answer relates to the same number previous. What I'm saying here is that most of the things you are saying here will also be replicated. You said in the A part of it will be replicated here. First one, they said if HAGM is earning insufficient revenue to invest in new exhibits and maintenance and repairs, a related risk may be failure risk, that is going concern. That is, if they are not able to continue to generate revenue and make more investments, the business is on the verge of what? Collapse. And when the company is on the verge of collapse, it is faced with a risk that's known as the going concern risk. That is why at every point in every audit that is done, one of the first things that the auditor tests is that going concern risk. Can this company continue to exist in the next 12 months? Can this company I'm auditing exist within the next 12 months? It needs to check that. So they need to put that one into perspective. So the second one, they say revenue may be materially understated because of failure to account for all sponsorship revenue, which is what I've said. Because there's a miscommunication between the sponsorship management and the accounts department. So there are unreported revenue because of that miscommunication. So revenue is understated, and that one has an effect on ultimately on the revenue of the business. The next one, their inability to separate sponsorship revenue from advertising revenue is also another issue, because it means that what they are saying here is that the information they have put in the financial statement for sponsorship and advertising will be what? Will be incorrect, because they will have understated their sponsorship revenue as well as their advertising revenue. They are not reporting the true position of these two items. Hence, it becomes an issue. Then the fourth risk is that the risk of HAGM is mainly that cash revenue will be understated because it has been stolen. If cash is taken by management and used for business purpose, there is a risk that both cash revenue and restoration will be understated. What we are saying here is that, another thing they also say, there is also some risk that if visitors are unable to get into HAGM without buying a ticket, revenue from ticket sales will be lost. What they are saying here is that before you take money from a business, you should always be looking at how you plug back into the business. For a business that you have started, you've not even allowed the business to perform. You've not assessed the performance of the business. You not started the money that you generated, you know, to invest it. you are using it for another, to incur or to embark on another project, which is not always advisable. So at the end of the day, you must have a plan in place. Oh, this is how much I have collected. The money you have collected, you can now say, okay, 10% of it, oh, I want to use it for another project. 90% I'll employ it back into the business. That is the way to make the business grow. Because what they are doing in this instance is that the working capital of the business will be grossly affected. And what is working capital? The money you use for the day-to-day running of the business will be inadequate, because the small money you are getting, you are taking it out of the business, thereby stifling the business itself, which is not always advisable. Then the second one they talked about is that some people also use that avenue because they know that they have weak internal control to gain access to the cinemas, to watch movie or to entertain themselves without getting the ticket. That one should also be blocked so that they can be able to get enough revenue from that business. Then the last one is the risk of booking system being not available does not give rise to any obvious business financial statement risk. Whether there is no significant risk with the backup booking system, the main risk is the business risk that HAGM will lose revenue during the period that the online booking system is unavailable, because potential customers are unable to buy tickets when they want to. What they are saying here is that you must have a backup plan, because you wouldn't know how many people have wanted to subscribe or want to buy tickets for your company, but they are not able to do so because your website is always down. In fact, it will just discourage them. Imagine you want to go to Amazon and you go there today, the site is down. Go there yesterday, the site is down. Today, you don't want to go there. You say that they are not serious people. So that is the way to go. So I hope I've been able to do justice to this particular question. But if you have any question as regards this topic that I've discussed this evening, I'm always available on the platform. You can reach me on the platform. I'll be glad to clarify or give you more insight into this, because this is more like an abridged class. It's not a normal class. So that is why I'm not expected to give all the information that is there. I just to give you the ones that I see as key, more like the key point is what I've given us. So if you go through it and attempt all questions that is in this material, and if you have any question or any doubt or any clarification, feel free to reach me on the platform. I'll be glad to respond. So far with audit approach that we have discussed, does anyone have any question? Is there something that you want me to clarify, at least for now, before we move on to the next topic? Even though we might not be able to finish it, but at least we'll start it today. Then we'll be continuing next class. Anybody? Please, I want somebody amongst us to send a chat saying that, oh, I can continue with the next topic, so that I know that I'm fine, that we are all fine. Please, someone amongst us should send a chat to me now saying that it is fine. Okay, somebody has put something there. Say, what is financial risk in relationship with business risk? Now, like I said, financial risk, this one, what they have here is financial statement risk, not financial risk. Financial risk is the ability of business to get enough money, to make enough finance. That's what that one means. When you look at risk, essentially, look at the prefix. What is the word that begets that risk itself? Financial risk. That is the inability of the business to get enough finance. That's what it means. Thank you very much. So that is what financial risk is. What we are looking at in this your syllabus is not financial risk, it is financial statement risk. So if you're looking at finance risk, okay, thank you. Finance risk and business risk, they are related. They are related. But if you're looking at financial statement risk and business risk, that is what I've just explained. If you need further clarification because of time, we'll look at that one you can buzz me again on the platform so that everybody will also benefit. I will throw more light on that. Thank you very much. Let's go on to the next topic. I'm taking another topic known as audit planning. Audit planning. Audit planning. So what you also need to understand, like I told us that the one I talked about, the audit approach, is also part of audit planning. Now, I always tell my students that there is what I call the audit circle. Audit circle. Audit circle start with what? Planning. After planning, you move on to what? Gathering of audit evidence. Under planning, you have audit approach, you have planning itself. Then after that, you move on to the second one, gathering of audit evidence. You gather audit evidence. That one, I know maybe my other facilitator will have done justice to that. But what they mean by that is ability to gather information that will enable the auditor to have an opinion, to form an opinion at the end of the audit. That is what you do. You make use of audit evidence. You gather audit evidence. The audit evidence you are gathering must be sufficient and must be what? Sufficient and must be what? Reliable. They must be sufficient and must be reliable. So that is what you do. Then after you go to that second stage, you move on to evaluation and review. That is the point where you sort your audit evidence. Which ones are relevant to the audit? Which ones are irrelevant? So the ones that are relevant are what you are going to use, because when you are gathering everything, you cannot separate which one is which. You gather everything. Then when you get everything, you now sort. Then when you sort, you'll be able to know which ones are related to this audit and which ones are just additional information. Then when you are done with evaluation and review, you go on to the last stage, which is reporting. ICANN examination from the syllabus, the rest of the syllabus, that planning takes the larger part of it. I think it takes 40% of the entire audit engagement. So when you are doing an audit engagement, it's divided into 4 parts. Planning, gathering audit evidence, evaluation and review of audit evidence, and reporting. So that is the way I classified audit circle. So planning is under, audit planning is under planning. So what is planning? Audit planning can be defined as the process in which the strategy is designed to conduct the expected result, which also defines the scope of the audit inside the company. The size, nature, and the time of the audit plan may vary. It depends on the size of the business. So what this one is saying in essence is that audit plan is more like it's called the course of action that shows how the auditor wants to go, the strategy the auditor wants to adopt in carrying out the audit engagement. The course of action in which the strategy, which will explain the strategy the auditor will use in carrying out the audit engagement. That is planning. Then under planning, we look at the audit planning memorandum. Audit planning memorandum is a document, is a plan that showcases all what the auditor needs to do, all the activities the auditor will need to do during the audit engagement. So it contains, for instance, terms of reference. That's the scope. What will the audit? What is the scope of the audit? It contains the timing. How long will this audit be? It contains the resources that will be used. How many staff do you need? How many audit staff do you need? How much are you going to pay them? All this information are contained in the audit planning memorandum. Now, what you also need to understand when you are looking at audit planning is that you need to understand your client business. ISA 315 specifically says that you need to understand your client business. If you don't understand your client business, then that means you will not be able to do a thorough job. Imagine you having an iPhone now, and all what you use your iPhone to do is just to make calls. You don't know other additional benefits, additional use of iPhone. Or let me put that one aside. Most of us are familiar with BlackBerry when it was in vogue. Most people there, imagine you have a BlackBerry then, and you cannot use the BlackBerry Messenger. You just use your BlackBerry just to make calls. That means you are underutilizing the performance of that phone. So that is what it means. So understanding your client business is very, very key. If you don't understand your client business, then there is an issue. You'll not be able to perform an excellent job. So that is very, very key. Sorry, there's a chat coming in. Okay. Okay. So that is what that one means. So you need to understand your client business. Under planning, we are looking at other things. Some of the things we are looking at audit risk. We are looking at audit risk. And what is audit risk? Audit risk is the risk that affect the auditor from expressing a true and fair opinion on a financial statement that he has audited. Audit risk is the risk that prevents the auditor from expressing a true and fair opinion on the financial statement that he has audited. So audit risk, that is audit risk. Audit risk has three main components. It has the inherent risk, control risk, and detection risk. And that takes us to the audit risk model. Inherent risk, control risk, and detection risk are the three components that makes up the audit risk model. Now, what is inherent risk? Inherent risk can be looked at from two angles. You can look at inherent risk from the angle of transaction. There are some transactions that are susceptible to what? To fraud, or that are susceptible to high risk. For instance, looking at your single financial position, your non-current assets, these assets are prone to what? Risk. Risk I'm looking at here is when you understate or you overvalue your asset. You overvalue your asset because if you have not factored in impairment into the non-current asset that you have in your financial statement, then what you are doing invariably is that you have overvalued your asset, which is not the best. So you need to factor in impairment. And impairment are what you do on an annual basis. You need to test your asset for impairment. And that test must be done. The proof of that test must be shown. So when the test is done and the proof is shown, then you'll be able to know that yes, you have done whatever you have reported as the value of your asset would have been the authentic value. That is one aspect. Another item in financial statement that is also prone to high risk is inventory. There are times you overvalue your inventory or you undervalue your inventory. For instance, you say you have 20 million in your account as inventory now. A good auditor will not take that word from you. Even if you are putting your financial statement, we need to ask for documentation. How did you arrive at this figure? Maybe we need to conduct a stock count to verify that what you have put there is the correct one, because when you are sorting your inventory, you need to classify them into various categories. For instance, you have a manufacturing company, if you are a manufacturing concern now, you need to look at the raw material. What constitutes of the inventory? What percentage is your raw material? What percentage is your work in progress? What percentage is your finished goods? All these you need to put into consideration. So you know that, this particular, by the time you do your stock take, or you organize your stock take, all these questions would have been answered. Another aspect also that's also susceptible to high risk is your debtors. There are some people that say they try to inflate the figures they have in the debtors. And one way you can correct that is to carry out what is known as secularization of debtors by confirming the status of each debtor. Let them let them send you their current balances with the company. From there, you'll be able to validate whatever they have put in that place. So these are some of the items that are prone to high risk, and they are also be regarded as inherent risk to the business. So another way you also look at inherent risk is the environment or sector where you operate. If you operate in the banking sector, it has its own inherent risk. Every business has its own inherent risk. For the banking sector, the risk is cash. So you have to be control around cash. For the oil and gas sector, the risk is the inventory. Inventory and revenue are the risk of oil and gas business. So you need to build your control around your inventory and the revenue. So on and on like that. education, they have their own, agriculture, they have their own risk. All of these businesses have their own inherent risk. What I mean by inherent is that you cannot shy away from them. You cannot look down on them. You just need to ensure you have an effective risk management framework in place. You're able to mitigate and reduce the impact of those risks on your business. That is inherent risk. Then control risk are those risks that the internal control you have put in place cannot detect. The internal control that you have put in place in your business cannot detect. Those are control risks. For instance, let's take us back to, because like I always tell my students, auditing is a living subject for me. I relate to it every day. Situations happening around the country, around me, globally, I relate to it as well as in line with auditing. Now let's look at this scenario. The the snake that swallowed 36 million at JAMB office. If you look at the types of internal control that we have discussed, Papa Musa, do you see anywhere where they make use of snake control? Do you have snake control? Or do we have zoology control? Or do we have animal control? No. You have put in place enough measures. You have put the right personnel there. You have authorization and approval. You have accounting and administrative process. You have management control. You have all those things. But this risk, animal control, this snake that came and swallowed 36 million naira, you have not envisaged it. You never knew that it's going to happen. So the risk, the control you have put in place, that snake has beat all the controls. He has defied all the controls. And that is why I was able to cut away 36 million naira. The case is still in court as we speak. They've not finalized it. So that is control risk. Then detection risk. Detection risk happens when the audit procedures that the auditor has implemented is not able to detect some risk or is weak in its what? In its operation. And what that one means is that this is as a result of the auditor's ineptitude, or better still, the auditor's negligence. Now, how does this contribute to the auditor's negligence? Now, if the auditor is taking a sample from a population, and that sample you are taking from a population is not a true representation of the entire population, definitely that sample is already what? Is defective. The sample is what? Is defective. And when you have a defective sample, definitely it means that the conclusion you have on that sample will be what? Will also be what? Will be faulty. So you need to ensure that you have the right understanding of your business. So how can the auditor minimize this audit risk? The way the auditor can minimize this risk is, first of all, he needs to update his knowledge every day. Auditing is a living subject. It evolves every day. I can have a program which they call mandatory continuing professional development. They've changed it from what it used to be. We used to call it MCP before. Mandatory continuing professional education. That's what they used to call it before. But since the advent of this COVID-19, they have changed it. It's now mandatory continuing professional development. What it means is that it is not until when you are gathered in a place that you'll be able to get education. So you can develop yourself via online, virtually. That's why you see most of the MCPD that they do now is virtual, online. And you see them go to the entertainment center again. They don't do that again. So they do it online so that as much people can benefit. And the price has also gone down from 30,000 naira to 15,000 naira now. So it is affordable. The next thing you also need to understand is that the ICANN annual conference that they're supposed to hold in September will also be done via Zoom. They're not going to go to Abuja to have that. I'm not sure they're going to gather in Abuja because of social distancing rules. It's going to be via Zoom. If NBA can do their own via Zoom, then who is ICANN? So all these are avenues to equip yourself to get understanding. When you are auditing a client, you should be able to ask questions. Let me see your standard operating procedure. Let me see your finance manual. Let me see the document that set up this company. Let me have all the information so that you can have the right information and be able to use the right procedure to get the best out of the information that is needed. So those are the three risks that makes up the audit risk. Now, the audit risk model is coming in question here because of the three risks, it is only one risk that the auditor can control, and that is the audit risk. So if inherent risk and control risk is moving in an upward direction, audit risk is moving in downward direction. They don't go in the same direction. Inherent and control risk move in the same direction, where the audit risk is moving in the opposite direction. And what you also need to understand is that the inherent and control risk, you cannot eliminate them. The best you can do is to mitigate them. And one way to mitigate them is to do what? Is to get to understand your client business. All the information that you need, ensure you have it. By the time you be able to do that, you're able to mitigate and reduce it to a BRS minimum. Then, one thing you also need to understand is that when you are doing your planning, you also need to ensure that you need to factor in the type of business that your client does. Is it working in a computerized environment, or is it doing a manual job? If what they are doing, they are making use of registers every now and then, they don't have any system. You need to be able to check if they have all these things in place, because that will form the basis of how you are going to plan for the audit. That will form the basis of how many hours, how many days, how many weeks you are going to use in that audit. You also will factor in the approach you are going to adopt also. Using or factoring the use of computer, which will also go a long way in helping your system-based audit or system-based approach. You need to be able to factor that in when you are doing your planning. Then the next one you also need to understand is the materiality. Materiality, you look at some transactions, how they affect the occurrence of such transaction, how it affects the impact it has on the financial statement. There are some transactions that when you see them, to some companies, they are immaterial. Just like, for instance, I use an example. If you take a 1.5 liter of Eva water and you put a pinch of salt in it, you might not be able to detect that there is salt in that water, because the level of salt you have put is very small. The smallest quantity or minute quantity. You might not be able to detect that salt has been added. Or if you are putting a teaspoon of salt in that bottle of Eva water, you will see that you taste salt in that water. So that is what materiality is. Materiality is relative. Some company, 5,000 naira is big money. Some company, 5,000 naira is negligible. So that is how materiality is. So you need to be able to look at the materiality threshold for every company, of every client of yourself. Look at the materiality threshold. Look at where you come in. What is what to them. And the only way you can get that is looking at the financial statement and having a chat with the management. What are those things that you want me to focus on? When you are doing an audit, you always ask that question. What are the things you want us to focus on? Should you focus on the inventory? Should you focus on the bank? Should you focus on the asset? They always ask that question so that you give them a sense of direction to know what they are doing. So that is where materiality comes in. So what you also need to understand is that the auditor, when he wants to conduct the audit, he needs to be able to check. You need to have this objective in mind. One, you should be able to obtain reasonable assurance that whether financial statements are free from material misstatement. Like I always tell my students, no financial statement is free of misstatement. There is one level of misstatement in every financial statement. The only issue there is the materiality issue. What is the level of misstatement in the financial statement. If the financial statement has a 95% assurance that the information there is correct, that 5% is negligible. But when they say the financial statement has an error of, let's say, 40%, that means you cannot overlook it. You need to investigate. So that's why I always tell my students that there is no financial statement that is error-free. It's just the level of error that makes the whole difference. So you need to be able to obtain an assurance. And one way to obtain that assurance is to get what is known as what? Letter of representation from the management. One way to do that is to get letter of representation from the management. Letter of representation will show, management will tell you that yes, we are responsible for the financial statement and we are affirming that there is no error in the financial statement. They will tell you, because at the end of the day, it's what they tell you that you work with, but you need to also do your own, exercise your own due care, skill, and diligence while carrying out the audit. Then secondly, to report on the financial statement, and communicate as required by the ISA in accordance with the auditor's finding. When the auditor is unable to obtain reasonable assurance from the qualified opinion is insufficient, the auditor must disclaim an opinion or resign. What they are saying here is that when the auditor is not able to obtain that assurance from the management, he can do two things. Either he qualifies his opinion or he issue a disclaimer. There are three things he could do. He qualifies his opinion, issue a disclaimer, or he resigns from the audit. All this one we look at under the chapter 14 of reporting. It's contained in chapter 14 reporting. We'll look at all these ones. So let me not bore us with so much information. Chapter 14 is part of what we are going to discuss in this class. So we'll look at it in a broader perspective. They say the ISA 200 requires the auditor to comply with all ISA relevant to the audit and comply with relevant ethical requirements. Look at it. So look at audit trees. I've discussed all these things with us. So you can just read it and gain knowledge or an understanding. So what we'll do now, let's quickly look at question 1. Then we call it a wrap for today. They say ISA 300, planning and audit of financial statement, provides guidance to auditors. Planning and audit involves establishing the overall audit strategy for the engagement and developing an audit plan. Adequate planning benefits the audit statement in several ways. Requirement: explain the importance of audit planning. This one is very cheap. So look at what is the importance of audit planning. So let's look at it. 1, it helps the auditor devote appropriate attention to important areas of the audit because he knows what to focus on. We have discussed that. Secondly, it helps the auditor to identify and resolve potential problems on a timely basis. So you know where there are problems and you bring your searchlight there and get it resolved. Thirdly, it helps the auditor to properly organize and manage the audit engagement so that it is performed in an efficient way. By developing the audit planning memorandum, you will be able to tackle this. The next, in an efficient manner. The next one, it assists in the selection of engagement team members with appropriate levels of capabilities, and competence to respond to anticipated risks and proper assignment of the work to them. You know, I talk about the resources that time under the audit planning memorandum. You know, look at the audit that you want to do. If you are going to use a business risk approach, then you need to know that you are going to use more skilled audit staff, because the Big Four, they have different sections in their firm. So maybe you look at those ones that are core. Imagine when you are auditing an oil and gas company now, they have the energy department, energy unit in the Big Four. That means you are going to bring people that have that expertise and competence at the energy unit. You bring them, you include them in the engagement team. Remember, you are talking about the engagement team yesterday, partner engagement team under practice management. So you need to bring them on board and ensure that those who that you bring on board, they will add value to the audit. And one way you can do that is when you do planning. There's a saying that says, he who fails to plan, plans to fail. So if you have planned, definitely you get a successful outing. The next one, it says, it facilitates the direction and supervision of the engagement team members and the review of their work. That is self-explanatory. Then the last one, it assists where applicable in the coordination of work done by experts. So this one, let me just quickly explain something here. Who is an expert in audit? Who is an expert in audit? An expert in audit is anyone that has competence in other areas outside the field of accounting and auditing. I say it again, an expert is someone who has knowledge or competence in other fields of endeavor outside the field of accounting and auditing. So that is an expert in audit. It's not English. If you use the word expert in English, it means a different thing entirely. But expert in audit is contained in ISA 620, using the work of an expert, using the work of an auditor's expert. There are two experts in audit. You have the auditor's expert, you have the management expert. Management experts are those experts that the management use their services or consult their services while preparing the financial statement. For instance, every management staff, every management of your client, you always have their own lawyers, solicitors. They have their own engineers. They have their own people that have skills in other areas, statisticians, actuaries. Those ones are management experts. But the auditor's experts are those experts that the auditor use in the course of the audit, in which he will not, whatever is going to place assurance on their work, but he will not say it on the face of the financial statement that he has reviewed that based on the information I got from this expert. No, he's going to assume responsibility for the entire work that the expert has done. So an expert is someone that has competence in other areas after the field of accounting and audit, as in expert. So they say it assists where applicable the coordination of the work done by experts, so that when you are planning, so that when you go to you get to the engagement, you get to the client company, you don't say that, oh, I need the service of a lawyer. No, you will have planned for it. Oh, as I'm going, I need the service of a lawyer. Oh, I need the service of a quantity surveyor. All these people that I'm mentioning, lawyers, surveyors, actuaries, scientists, computer engineers, all these people that I'm mentioning, they form part of what is known as what? Experts, as far as auditing is concerned. So that is where we'll call it a wrap for today. But I want to ask, if you have any question as regards what we have discussed today, please, you can chat me up on the platform. I will be ready and be glad to respond to all your questions, comments, and clarification. Now, before we close for the day, I want one or two persons to respond to say that we are fine or we are not fine, so that I know that I've done justice to 2 chapters today, because our time, the clock is ticking very fast, and we still have like 3 topics to go. That's why I try to cover 2 today. That I know that next class we'll be able to cover maybe additional 2 or maybe 1, so that we know that the upper class will have been done with everything that I think that you need to have. Any person to just chat me up, put it on the chat, so that we can know what's the next line of action. Because I know very soon now the moderator will sign me out, and we'll be done for today. Thank you. Okay, another person, so that I know we are like 14 there, 13 or 14. I need one more person to say that, so that I can sign out for now. Okay, we are fine. Thank you very much. So, as I always said, I'm available 247. When you put it on the platform, I'll be glad to respond at any time. Thank you very much, and have a lovely week ahead. Thank you. Mr. Moderator.
Yes, sir. Thank you so much, sir.
All right, sir. Good night.